slide. So can we change the slide? Okay. Now, both charts you can see account for the positive market growth in the quarter 2021. So collectively, about $26.5 billion in deal volume were issued, which is $3 billion more year on year. And this marks a 13% year-on-year increase, as well as a 35% quarter-on-quarter increase. So on net, this growth confirms that a structured products market continues to draw increasingly more investment. And the latest proof is that in both February and March, the issuers exceeded $9 billion. So to sum it up, the market seems to have stabilized after the volatile 2020. And now it takes full advantage from the rather complex and uncertain market outlook lying ahead. So that said, we are also seeing very good rollover opportunities from expiring products that commenced since October last year and which is peaking in March. And this is something we'll be showing you more in detail a bit later in the presentation. Let's now look if something's changed with the issuer's activity. So 4 banks issued each above $3 billion worth of structured products in the first quarter. So first place this quarter is for Morgan Stanley on the back of just below $4 billion. And they also recorded the biggest year-on-year sales growth of 61%. Barclays have slightly lost ground as they fell from the first place as in the first quarter last year to the second place now with a 10% year-on-year sales growth. Coming third, Goldman Sachs have issued just about $3.5 billion worth of products, which represents 26% year-on-year sales growth. And Goldman Sachs are followed by JP Morgan and Citigroup, who issued roughly $3 billion each. So with Morgan Stanley again on the top, 8 out of the top 10 issuers experienced positive year-on-year sales growth of between 10 and 61%. So the 2 exceptions are Credit Suisse and CIBC, whose sales didn't grow year-on-year and were down 25 and 11% respectively. From the banks who are not in the top 20, top 10 issuers this quarter, so positive year-on-year sales growth has seen Bank of America, Toronto Dominion, and Bank of Montreal. Let's now see the payoffs. In terms of preferred payoffs, the market has remained largely steady from the end of 2020 to the start of 2021. So in this regard, we see a continuing trend towards income products and early redemption mechanisms. So sales volumes from income products have been up 44% year-on-year, and the income products currently represent 60% of the market. In the same time last year, it was growth products that accounted for half of the volumes. Now they've attracted 12% less in sales, and eventually they lost 11% market share. So the second ongoing trend, we see it in the increase of products with autocall mechanism. So you can see the pie chart in the top right corner. This quarter, autocallables realized 55% more sales than 1 year back. So in terms of market share, they also gained 14% on the deals without a redemption feature. And this means that in 1 year, the balance between autocallables and non-autocallables tipped in favor of the autocallables, which now represent over half of the sales volume. It may also be interesting to point at another development, a shift towards short-term maturities. The average investment term decreased from 3.4 years in the first quarter of 2020 to 2.8 years in the first quarter of 2021. So in terms of autocall observation feature, the most popular remains the quarterly observations with 2/3 of the volume and without change year on year. But what's new is that products with monthly observation gained 5% on products with annual observation. Of course, we know, and it's been proven across markets that having more frequent observation increases the chances the investor get to exit the product early and secure the coupons. This is because, as we saw it in shopping markets, an autocall event can be missed for 1 or 2 days, and with the only observation, the investor would have to wait for another year for a potential autocall to occur. Now, a word about the capital protection. So the environment is durably not favoring structure. No, still in previous, yeah. So environments not favorable for structuring guaranteed products. So this is the reason why capital protected products shrank by half this quarter and represent a tiny 2% of the market volume. Protection via put spreads has virtually disappeared this quarter as well. But that said, the offer continued to be dominated by soft protection in the shape of a knock-in barrier and to a much less degree by buffer protection. So year-on-year market share of knock-in protected products increased by 10%, while the part of buffered structures has decreased. So with which knock-in barriers currently represent 70% of the sales volume against only 18% for the products with a buffer, or a rough ratio of 4:1. The reason, of course, is the higher coupon that can be offered because of the additional risk that is brought by the knock-in barrier. This quarter, the average offered coupon has been around 11% for the products with a knock-in, compared to an average coupon of 8.6% for the products protected with a buffer. So additionally, using the knock-in protection is often allowed to deepen the coupon barrier level. On the flip side, the capital protection via buffer remains more conservative as it acts as a hard protection. So the share of geared buffers remains flat year on year. So you can see below the table with the most used payoff types. So the list combinations represent over 2/3 of the sales volumes raised in Q1. As you can see, the payoffs that are firmly on the up are the autocallables in their two versions, those distributing coupons and those putting it coupon in memory. On the flip side, participation structure have mostly lost ground to income products. Now the underlyings. So single underlying products continue to represent more than half of the sales volume in the first quarter, and they've even attracted more sales year on year. I'd like to point here that the activity has been increasingly driven by more targeted exposure via single names. So single stocks linked products gained 10% market share on single index linked products. That's for one thing, but in terms of year-on-year sales growth, we see that single underlying products have been outpaced by worst of option structures. So worst of options has sold 21% compared to same quarter last year. They also gained 3% in market share on products linked to baskets. Again, this is because the correlation has come back down to normal levels with the volatility decreasing. Worst also a way to keep the currently offered coupons high by adding the risk of a worse performance. Products linked to equally weighted baskets were the only category that showed negative year-on-year growth, decreasing 56%. Now then, the S&P 500 still remains the most popular single underlying, despite 20% less in sales volumes year-on-year and a loss of 7% market share. Products linked to the S&P in isolation now represent 16% of the volumes, whereas they accounted for roughly a quarter in the same time last year. So the second most popular combination of S&P 500 and Russell 2000 was also 8% down in sales. On the positive side, worst of combinations of them indices that include a third underlying in the shape of Nasdaq and Dow Jones saw a year-on-year increase. Products linked to the Russell 2000 as a single underlying also increased by 80% year-on-year. So other single indices that saw a positive year-on-year sales growth were, for instance, the two MSCI indices for foreign diversification, so the EAFE and the emerging markets. So as I just mentioned, we see an increase in the more targeted exposure to stocks. Among the most used equity shares in the first quarter of 2021, the most growth experienced the shares of Tesla with 3,500% up and Apple 1,800% up. Other stocks underlying that have been popular in Q1 include Amazon, financial stocks as Citigroup, Wells Fargo, tech companies as Microsoft, semiconductor manufacturer Qualcomm, but also Netflix. Companies with 3 to 4 digit percentage growth include again Qualcomm, Advanced Micro Devices, Intel, biopharmaceutical AbbVie. So which were the thematics that got more traction? So we'll see it in a bit, but now I'd like to pass it over to Tiago, who will follow up with a quarterly performance of outstanding structured products. Tiago, over to you.
Okay, thank you, Nikolay, and thank you for listing a lot of the different underlyings being used. Look, I think Nikolay wanted to give you an overview of how Q1 performed, and as you can see, it performed really very well for for the issuers, for the distributors, and for the clients. And before and now I'm going to focus more on the current environment going forward, and what do we think it's going to happen during the next months. And before going to the next slide, I think I just wanted to highlight that you have the Q&A questionnaire. So if you have questions during, on one of the slides, just post your questions there. We'll try to answer them at the end. If we can't answer, we'll come back to you by email. Okay, so I think something which I think it's quite important to highlight is Q1 performance. And why it is important? Because looking at Q1, there was a bit of volatility, at end of Jan, also beginning of March on S&P 500 with the COVID and some situations that affected the market. But overall, of course, S&P 500 being long on equity, probably the best trade during the Q1, and that no doubt. What I think it's important to highlight, and I think it's also one of the reasons why, 3 months ago we said that, 2021 was going to be a record year for structured products in the US, and we're already seeing some of that. And this is, for example, one of the reasons. Some of we basically get daily prices for the majority of structured products sold in the US. So what we wanted to create was some indices, and we basically split all the daily performance into the three buckets. The growth products, the income products, and the capital protectors. Okay. Within those, we weighted by how much was sold in the beginning, and we calculated every day. And our idea was, okay, how does the performance of these products daily compared with other asset classes? So we put there compared with S&P 500. So the darker gray line, so the one on the top, finishes as the best asset class. And then we also added the iShare US Treasury Bond ETF. And I think this explains a bit of the success of Q1, is that with interest rates now started to decrease, to increase, it means that the current portfolio of fixed income are basically underperforming, and that means that structured products actually perform quite well. If fixed income funds are down around an average of 4% as end of Q1, structured products outperform the fixed income asset class between 6 and 9%. Again, as expected, growth products are the one closest to the S&P 500. Interestingly enough, they didn't outperform because within the outstanding growth products, we have a lot of dual directional trades, so twin wins, which, because S&P 500 rallied a lot, are not performing as well as the S&P 500. Then, followed by the growth, you also have the income. And I think this is quite important to highlight that this is daily performance. And from end of December to end of March, we estimate, and we have 70%, more than 70% of all products here in the US market, the actual performance was 2.9%. That's impressive because if I analyze it, is around 11% annualized coupon, which is much higher than the current coupon being offered. And I think that's probably something which is going to be very positive and explains a lot the growth on the autocalls and the income products. And then, of course, the capital protected, which still have a lot of the market-linked CDs, still live and outstanding. They still outperform the fixed income, as you know, their performance is linked to the equity markets, so they have a positive correlation with equity markets and negative with the fixed income fund, which is quite interesting, and it just shows that actually, you know, diversifying and having the three buckets, it actually a very important benefit. Now, what does it mean going forward? Is and I think this number, I think it highlights all presentations, that 78% of all outstanding products are 10% or more above their initial strike level. That's and I think that's incredible. We calculate every day with our data the current level of the underlyings, the expiry dates, and these numbers, I think that they are quite impressive. This means that even the S&P 500, you know, slice down up to 10%, these products are still going to expire and provide a coupon, which this is why we are very confident on 2021, unless there is a major crash. You can see there also the best underlyings, and the other thing which I want to highlight here is the worst underlyings. That 3 months ago I told it was mainly linked to oil and gas. As you can see on the table to the right, they were back 3 months ago 50% down, so we're below their barrier level. They are now above their barrier level, most of them, which means that they potentially will provide the capital back, but not the coupons at the moment. And then you can also see is the market exposure. So 1/3 still linked to the S&P 500, but 6% to the Euro Stoxx 50. And I think that's that's something to highlight, that you know the S&P, the biggest risk is of course, you know, is on the S&P 500. And then looking forward, I think we also mentioned that, you know, Autocall futures are increasing their weight, and one of the reasons is that because equity markets recover, the rollover speed, which is, you know, it's basically an index that we created. It gives you the percentage of all the outstanding products that are expiring or maturing on that month, is now at 7%, which is a record from when we started recording this information back in Jan 20. As Nikolay mentioned, March was the biggest month of the year in terms of rollover opportunities, but there will be other peaks like in May, as well as later in the year. Okay, and I think to finish the presentation and the webinar, because we wanted to do it in half an hour, I think we wanted to show you, I think, you know, 4 key trends which we think, you know, people will start talking about and should definitely looking at. One is the coming back of the market-linked CDs, which you know, a lot of distributors complain to us saying that, you know, they really want to offer market-linked CDs, but you know, there are not that many in the market. The truth is now with what you can see on the left top chart is that the yield curves are now coming back to normal, not flat as they were 1 year ago, and much higher than they were at the end of last year. Just in 3 months, they actually had an increase of almost 1% on 7 years or more, which means that, you know, if interest rates continue to increase, market-linked CDs will come back. What type of indices? That's still a question, because, you know, the current interest rate environment doesn't allow to buy 100% calls, and that's why we've put there on the right a graph on that we did also in France on the type of underlyings for Q1. And interesting enough is, you know, Europe is, you know, is now almost recognized as the next Japan, you know, with negative interest rates. We see it on the French market, which is very innovative, as most of you know from the issuers present in that market, is that nowadays 50% of all sales are linked to decrement indices, which is basically synthetic indices that is basically total returns that retrieve, that subtract a fixed dividend rate in order to offer higher participation or higher coupon. And I think potentially that's something we might, I think we are seeing the first ones during 2021 in the US, and I think we will see them growing. The third, I think, theme here is actually thematic. Thematic is increasing, including ESG. We know Biden administration is putting a lot of effort on the ESG efforts, but it's not only that. Although ESG is growing, and it's although it's still less than 2% in the US market, compared with 56% in France. Other, let's say, thematic indices, thematic strategies, as Nikolay said, with baskets, with specific stocks that becoming popular. And if back in 2019, we saw that, a little bit more than 10% were thematic structured products, they're now at 22%. And I think this is also a way for distributors, local dealers, the wirehouses to differentiate themselves. And I think that's probably something we'll see continue to grow. And last but not least is, of course, if last year it was all about the S&P 500, volatility was high, as we can see from the bottom right chart. And here what we have is a 90 days historical volatility annualized. You can see it was back in June, we got to 90% on energy. What we've seen is on the S&P 500, which is the light gray, is now back to normal between the 10 and 20%, which was what happened before COVID. What we've seen is now that all these autocalls with higher coupons are now coming back to the markets, clients are going to request, to keep the same level of coupons. And I think what we believe is going to happen, stock or single share or worst of stocks, which are already growing, we're also going to see a bit more choose of more volatile stocks like energy and technology compared with other stocks. I think that's probably a trend that we'll see during the next month, unless volatility starts to pick up. Okay, so this was our presentation. We have a couple of minutes for questions, which we'll be happy to answer if anyone has. So if you do have, please, write them on the Q&A. We'll be happy to answer any. We'll give a couple of more more minutes for people to write their answers, as I know that it takes a bit of time. So meanwhile, Joe, you're the one who actually can speak from all the participants. So would you, do you have any question for us? I think you, or any other slide that we should show to the audience?
Hi, Tiago. I don't know if I should speak for the full audience. First, I do want to thank you and Nikolay for some great information and insights today. My question would be, how do we provide this information, this presentation to the audience? Can they request it and we'll send it to them electronically?
Yes, we'll send them electronically. We're also recording the webinar. So what we're going to do is, we'll email all of you the presentation. I can also see someone raising their hand. No. Sorry, I thought there was someone raising their hand. I'm not sure if you had problems in, yeah. Okay. Look, I think Joe, Nikolay, I think there might be some problems with the Q&A. As I saw something appear, someone wanted to ask a question, but I can't see it anymore. Oh, perfect. Someone asked, at what levels of rates do you think CDs will become attractive? Okay, that's a very good point. And a very good question. I think it depends also a lot of the funding level of the bank. I believe if you think on a 5-year market link CD, to at least offer capital protected and 100% participation on a property index, I think it needs to be above 1%. Without 1%, it's going to be extremely difficult to actually offer anything less than 5 years with at least 70% participation. Okay, well, I think that was the question we had. So yeah, thank you very much for everyone for participating. As I mentioned to Joe, we will email you the presentation as well, a link for the video if you want to review. But yeah, please, if you have any questions, you can always reach out to one of us. I will be happy to answer and speak with you. Okay, so thank you very much.